Yeah, so I mean, I started covering Bitcoin back in 2017. Back then, I expressed concerns about the price. I was also concerned about the Bitcoin fork and things like that. And so I sat on the sidelines, and I wasn't one of those like Bitcoin bears, but I also wasn't bullish on it. And so as we had kind of improving fundamentals in 2018, 2019, like the forks were sorted out, we had the improving network effect, we had institutional grade custodians. In April 2020 is when I got quite bullish on Bitcoin, and then I increased bullishness up to about June, and then just been super bullish since then. That as we kind of go along this halving bull market, people start to buy in at these higher price points, and especially a lot of retail investors tend to get caught up in emotions, and they're more likely to kind of go in at the top. And so there's kind of smart money that buys in early, or like leverages early, like MicroStrategy did. And then there's always like these concerns where if you look back in 2017, there were investors that like bought Bitcoin with leverage at the top, and then there's like stories of them getting like crushed when Bitcoin falls, like however much it falls. And so my point was that as we go on this bull market, just be kind of cautious with the amount of risk you take on, because Bitcoin back when I went long at like 6,900 was like a no-brainer. I was like, this thing could go up 10x or more. And so it's like that was such an asymmetric move. But then as you get kind of deeper into this halving cycle, and you kind of the on-chain indicators start to get more heated, it's a little bit more consensus. That's when it's like, okay, now coming in with your massive all-in purchase or leverage purchase, it's like, just think this through. Like, make sure you know what risk you're taking on. Make sure you're willing to handle the volatility, because last thing I want is someone coming in towards the later stages of a bull market and then getting hurt. And it's not even that I necessarily think that this is later stages. I think by most indicators it looks kind of mid-cycle bull run. Basically now it's like, I still think it's going higher, but it's less of a slam dunk than it was at like below 10. It's only been 3 cycles. This is like the 4th cycle. And so that's why I've been avoiding specific price target. And there are certainly, like, if you look at previous halving cycles, the peak compared to the prior peak, I mean, the last time was a 20-fold increase over the prior peak. And so if you were to get that, I mean, that's how you get to 400,000. Even a 10-fold level over the previous one would be at 200,000. You have to be careful about extrapolating too much, because the past is just kind of a signpost. It gives you kind of indicators, and so it can overshoot or it can undershoot either of those metrics by a pretty wide margin based on what happens in macro land. So for example, if we get that yield curve control, and if we get a greater institutional adoption, that's where you can get one of those, like, say, super cycles like some of the analysts are talking about. That's certainly on the table. On the other hand, if you get let's say you get yields rise super far, that could put a dent in the bull run, and maybe the bull run tops out a little bit lower than people expect. There's a pretty big range of outcomes, and it's mainly because supply is known and demand is not. And so the best we can do is kind of monitor these indicators and say, okay, like, where are the risks, where are the opportunities, how far are we in? And I think by most indicators, mid-cycle is a good way to describe it.